Good afternoon, everyone, and welcome and thank you for joining us on our new series of webinars for 2022. My name is Sean Kimji, and I'm the Vice President of Wealth at Alterna Savings and Alterna Bank. A couple of housekeeping items before we begin as we wait for some more individuals to join us. Everyone will be in a listen-only mode, and this webinar is being recorded. So if you do want to go back and revisit some of the elements or hear the webinar again, it will be made available on our website, likely in a day or two after this webinar concludes. If you do have questions, we have received many questions through the original online submission, and the questions, if they do come up, can be submitted via the chat, and we will endeavor to get through all of the questions today. If we do not, we will certainly try and get all those answers to any questions you have responded to in a timely fashion after the webinar. I am excited to present the webinar series for this year. This year, we will be hosting approximately 8 webinars, which will encompass many topics such as tax, estates, markets, and also some of the other events that have an impact on your investments, as well as the planning that you undertake to achieve your financial security on a go-forward basis. And today is the first of this series of webinars, and it is in regards to a question that we get asked a lot of, and that is, I'm approaching retirement or I'm in retirement. How do I take my savings, begin that decumulation? How do I do it effectively in a tax-efficient manner? Do I withdraw from certain products first, such as my registered investments or my TFSAs? What about government benefits? What about the tax implications? So I think this is a very timely webinar. You'll see on the screen that it is entitled The Ticket to Ride. I'll let Doug, our guest speaker, talk more about the retirement income decumulation execution on the title slide as he's got there. And certainly, we're very excited to continue these webinar series throughout the year. I'll have some more information at the end of the session today on some of the dates for the next webinars and what you can expect to see coming from that throughout the year. So just to briefly introduce Doug Carroll, who we've had on here before, and we certainly appreciate him as a well-informed resource and expert. He is the tax and estate specialist for Aviso Wealth, a wealth management partner to credit unions across Canada. He previously ran an estate planning law practice and was an advanced case consultant with a life insurer and a mutual fund provider. Doug also holds a business degree and a Master of Law, specializing in tax, and is qualified as a certified financial planner and a trusted estate practitioner. He's been doing this for 25 plus years, supports the credit unions, financial advisors, has written articles, has done individual case consultations, and of course, webcasts like we're doing today. So with that, I will pass it over to Doug Carroll to get started on this very interesting topic.
Okay, thanks, Sean. And yeah, I was looking myself at the title that I'd put on this Ticket to Ride. I just like the title, and it had retirement decumulation, and it fit. But there'll be no more Beatles after this point, other than just the fact that you do have to make some decisions about what you're going to do to decumulate your accumulation of savings once you get into these retirement years. And that question about what's first or what's the order of things, I'll address that. There's no simple answer to it. So if you're waiting for the formula at the end that says this one, then that one, and that one, or 50 of this, 40 of that, whatever it might be, there isn't a particular formula that applies in every circumstance, in every year. But I'll get a little bit into that about the process you need to go through to make that decision, to decide how much you draw from those various places, and then how you'll continue making those decisions to your benefit, frankly, to be able to adjust as you go from year to year, as you move forward into your retirement and through your retirement. So I've got a few topics that we'll get into here. I'm not getting into some crazy mental math in going through this. There will be some numbers that I'll touch on, particularly in talking about the nature and the extent of old age security and Canada Pension Plan when I get to the topic on public pensions, which is early on. And then otherwise, I'm outlining the different sources that you may have when you go into your retirement, and what kinds of other considerations there are on top of strictly the dollar values and the choosing from among the places that you draw down. So what kind of a retirement are you looking forward to, or that you might be able to have based on your expectations of how you're going to spend your time, as well as the money that's available to fund that, and how to make the decision about drawing from these various places. So it's not about what is the formula for the decision, but it's the contributors into that discussion and how you're going to spend your retirement. That's what we're going to go through here. So I'll start with this this visual here, which I like as a representation. You may be familiar with this. It's the old, I don't know if you call it a fable or the myth or what it might be, but it exists in a number of cultures, and it's about the wise men or the blind men in a cave, and they come across something and they're trying to figure out what it is, and each of them is touching a different part of this thing and saying what they think it is. So one that happens to touch the trunk says, "Oh, it's a snake," and another who touches the side of it says, "Oh, it's a wall." I think about that and think, boy, this must be a really calm elephant ultimately, if you're in a dark room or you're a bunch of blind men who are poking away at this this animal. But the idea of it is that you're only experiencing part of it when you touch one part of it. In fact, there's a lot more going on. And similarly, when we're talking about retirement, we often hear people or think about it in terms of what age are we at when we start into our retirement, and that certainly is a critically important decision point about when you begin your retirement and how much time you are funding during the course of your retirement. And that's the when of your retirement. But there are a lot more things involved with it. There's obviously the what of you have, or what that you have, that is going to allow you to carry through in your retirement. So the accumulated wealth that you have, which will sustain you, along with the other entitlements that you have to public pensions particularly, but also the drawdown off of those other non-financial assets that you'll take into your income, that you'll draw into your usage as you go through retirement years. And as you work your way around this this circle, going around the elephant here, you get into the other questions that might be involved. Obviously, who, that's you personally, definitely, but also usually a spouse. Sometimes it can extend out to other family members who you are supporting and may continue to be supporting, particularly if there's a disability of someone involved. And then what's going to happen with your estate is usually part of the consideration of how you want to take care of those after you are gone, as well as taking care of yourself, your spouse, and those who depend upon you when you are going through your retirement. And then just working the way around, where are you going to spend your retirement? Where are you going to be living? What kind of surroundings are you going to have where you are located? And when I say where, I mean that both in terms of geographically where you might be, whether it's in the same place or moving to another town or another part of the province, or perhaps even further afield, as well as the kind of accommodation that you will have during the course of your retirement years, which is likely going to change from the earliest stages into your later stages, although quite often people do want to remain in their homes. It's not always possible, but if it is, then that's certainly desirable. So from there, I'll just touch on these last couple of points about the why, having some purpose in your retirement years, because the idea of just sitting there and on a rocking chair and watching the world go by, that's perhaps how people might have seen it back in the decades or centuries back, where people worked until the point where they couldn't work anymore and then didn't have much left in them. But these days, there's a lot more that might be involved in your retirement years. So what does it look like? How are you going to be a contributor to yourself and to others in those retirement years? What kind of purpose will you feel in those years? And the last point is what we're talking about here, more specifically about the how of drawing down on the wealth and where you spend your time. So what kind of a decumulation plan do you have? So there gives you the elephant looked at in all the individual components, and then in total, those are the questions that that come up when you're thinking about your retirement years. So I'm actually going to get into the different components that that you have with your retirement sources for your income now, and I'm starting here with your public pensions, and I'm going to break them down and give you, as I said, some numbers, but I'm not going to go crazy. They're most of the numbers that you'll see. I don't think I have much beyond this this one slide with numbers on it, but I think it is important to get these figures down, both as a as an understanding of what is going to supplement your retirement years apart from your own savings, but also as a reminder of the limit that that's available to you through these public pensions. So we have two main programs: the Canada Pension Plan and Old Age Security, and then we also have the Guaranteed Income Supplement, which is a part of the Old Age Security program. It is intended to alleviate poverty. So I'm not going to talk in any more detail about the Guaranteed Income Supplement. It certainly is critically important for people who are at a low income level, but I'm going to mainly have my comments here about the Canada Pension Plan and Old Age Security. So starting with the Canada Pension Plan, CPP is a program that is available to you when you are working, and it's required that when you have earned income from your employment, that there are premiums paid into the Canada Pension Plan from your earnings, which then fund your later retirement years. So you get credits for the later years that you will then draw off of the Canada Pension Plan. The intention of the CPP has been, up until recently, in terms of the replacement, is to replace 1/4 of a set income ceiling, which is called the year's maximum pensionable earnings. So it's based on that figure, which indexes from year to year. Right now, this year in 2022, it's at $65,000. So the 1/4 replacement of that means, to get the tough math, is somewhere around 65 divided by 2 is 32 divided by 2 is 16,000 or so, is what it is intended to replace. So that 1/4 is now being moved up to 1/3 as we're seeing our Canada Pension Plan premiums being increased. For the last 2 or 3 years, we've seen that. And then again, there'll be another increase next year that will happen. And then there are some further adjustments that are happening in the next 2 or 3 years. So we're in this transition from the program replacing 1/4 to 1/3, but only 1/3 or 1/4 to 1/3 of that YMPE level. So if you are making an income of 100,000, just to give it a round figure, you don't get the replacement of your full earned income. You get it based on the YMPE. It also has not only the retirement pension, but there are other components to it. If you become disabled and you've been a contributor into the Canada Pension Plan, then you can get a disability pension. There are also survivors pensions for a spouse. If you die, then there'll be a survivor's pension for your spouse, as well as your dependent children. And then there's a death benefit. It's a relatively small amount that comes out of that program. So the Canada Pension Plan at its maximum will give you $15,000, give or take, right now in 2022. That's the maximum amount that you will get under the Canada Pension Plan. Basically, if you've been a full contributor over the course of the years between 18 and 65, some of those years are taken out to allow for low income earning years. But if you have made that level of income and you've been a contributor to the Canada Pension Plan, you can get the full amount. That's at age 65, and that's referred to as the normal retirement age. But you can actually take the Canada Pension Plan as early as age 60, or you can delay it to as late as age 70. If you take it early, for every month that you start the Canada Pension Plan prior to your age 65 birth month, then you get a 0.6% reduction in the amount that you would get from the CPP if you had taken it right at age 65. So that takes you down to a little under 10,000 if you take that right at age 60, and it takes you to an amount much further than that, over 20,000, if you wait until age 70. Because if you wait after age 65, you get a 0.7% per month premium to the amount they get under the Canada Pension Plan. Then the old age security program is different from the Canada Pension Plan in that, unlike the CPP, where we pay premiums for our own retirement pension under the CPP, the old age security is a payment that is made from the government out of general tax revenues to people based on being a Canadian resident. So you get the full amount of the Canada Pension Plan, or the old age security, which is about $7,700 right now. You get that full amount if you've been a resident of Canada for 40 years after the age of 18. If you've been a resident for at least 10 years, but not the full 40, then you'll get a proportionate amount of the full amount. Again, $7,700 right now. The CPP, it indexes on an annual basis. Old age security indexes each quarter. So currently in this quarter, January through March, this is the figure, and then there will be an index that will be applied to that once we go into to April. If your income exceeds a certain income level, then the old age security will be clawed back. I'm sure everyone who's in retirement or heading for it has heard that term, clawback. It will be clawed back. It'll be taken back, the old age security, and it reduces the amounts available to you. Similar to the Canada Pension Plan, but only on the upside. If you delay taking the old age security, you don't take it right at age 65, you delay it out further in time, no later than age 70, you will get a premium of 0.6% per month as you allow for that to grow in value, and then you will start it at whatever date you choose. Again, age 70 is the later that's going to happen, latest that's going to happen. So sometimes when you look at the CPP and the OAS, people will say, I'm going to take it as soon as I'm entitled to it because I don't want to miss out on it. And as that may be something that feels like it's a good idea when you start receiving that income, you have to be careful to think about your own life expectancy and how long that is going to sustain you for. So though these amounts are not generally going to be sufficient to provide your entire retirement income, they can be a very significant base for it. So I just want to touch on this notion of taking it early on the belief that if I don't, then I'm not going to get it later on. And I want to look back. If you recall, there's this old marshmallow test that you've probably heard about in the psychology literature, in pop psychology. It's gone from the research area over into pop psychology. It gets talked about a fair bit, where this researcher by the name of Walter Mischel and his colleagues, they had a test where they would have young kids, kindergarten kids, they would bring them into a room and they would sit them down and have a conversation with them. They'd have a marshmallow sitting on the plate in front of them and say, I've got to leave the room and I'll be back in a minute. If I come back and that marshmallow is still there, I'll give you a second marshmallow. And the idea of this was to test the children's ability to not be motivated by taking the marshmallow first and to delay the gratification of that. And the idea that they were using it for research purposes was to look at the immediate impact, but also then to track these children over the course of time and see how this might have affected their lives later on. And as it turned out, those who were able to delay actually a lot more stability in their lives later on than those who took the marshmallow right away. And then some decades later, in 2014, Mischel wrote a further book, which was much more consumer-oriented book. And there was a really interesting observation that was one of the feature when this book was promoted. And you got the quote here: "The most important thing we learned is that self-control and the ability to regulate one's own emotions involves a set of skills that can be taught and learned. They're acquirable. Nothing is predetermined." And where that's relevant for retirement income, and particularly for old age security and Canada Pension Plan, is that based on statistics, you are likely going to live much longer than you think you're going to live. And if you take the old age security or Canada pension plan at an early stage, you are locking into the lower income level. To the extent that you might be able to delay that, then you may be serving yourself better by waiting and taking a larger amount later. It does depend on circumstances, how much you participated, what your contributions have been in terms of the Canada pension plan, life expectancy. If you do have a low life expectancy based on your health, then that might influence you to take sooner. But otherwise, it's a really important exercise to go through, to think through and discuss with your financial advisor whether to take the old age security or the Canada pension plan when you immediately become entitled to it, or to delay it off in time. So I'll leave that with you. And now I'm going to turn and talk about some other sources of money that will come in your retirement years. Employer pension payments that grow up for your benefit are registered pension plans generally. And there's two types of registered pension plans, mainly two types of registered pension plans, but there are also some hybrids. And the first one is called a defined contribution registered pension plan. And under a defined contribution plan, your employer puts a certain amount of money into the plan, which then you make investment decisions about, and it accumulates in value based on those investment decisions until it's a pool of money that's available at your retirement years, and that will then be the pot that's available to then pay for your later retirement. With a defined benefit pension plan, a DB registered pension plan, the way that works is, instead of telling the employer to contribute, or the employer committing to contribute a certain fixed amount into the plan, there's a calculation based on how much you will be entitled to as a pensioner coming out of that plan. And that entitlement you would have at the far end of things on taking a retirement then dictates back to the employer how much has to be contributed into the plan. So the employer, in the first case with the defined contribution plan, employer knows how much has to be contributed in. You don't know, though, how much is going to be available in those retirement years to fund your income needs in retirement. Under the defined benefit plan, you know, or it's calculable, how much you will get as your retirement pension based on a formula, and then the employer, through an actuarial firm, will be told, here's how much you, the employer, have to contribute into that plan. So that's the difference between a defined benefit and defined contribution pension plan. You also have some other possibilities. Again, there can be some pension plans that are set up with both a defined benefit and a defined contribution components to the plan. There's something called a deferred profit sharing plan, which connects up very much with the RRSP rules. Under a deferred profit sharing plan, a DPSP, the contributions of the employer are dependent on the profitability of the employer. So if things go well, and usually these are set up in such a way that that's a known issue for the employee, that contributions will be made based on the performance of the business. And so the employer or the employee will want to contribute into the positive growth of the business. And then the last thing that I've got showing here is group RRSPs, registered retirement savings plans. And I'm going to turn directly to RRSPs, because group RRSPs are, just as the name says, they are registered retirement savings plans that are together within a group. But otherwise, most of the rules that apply to the contributions and the accumulation in RRSPs is the same or similar for group RRSPs. The difference with the group RRSP here is that the employer is the source of some of the money going into the group RRSP, whereas when you have a personal RRSP, just your own, you're the one solely who contributes into your individual RRSP. So we had employer savings plans that we just looked at. Now we're looking over at personal savings, but personal savings based on the fact that you work. And the reason why I say that is that your ability to contribute into an RRSP is based on your earned income. So your earned income last year is the base for calculating how much contribution room you get into your RSP this year. It's 18% of your previous year's earned income that allows you then to have that much room to contribute into your RSP. There is a legislated maximum involved with that. So it's not wide open that if you made $1 million, you could put $180,000 into your RSP. It is capped off based on the maximum, which this year in 2022 is about $29,000, which is it means that you max out your ability to contribute into, get room to contribute into RSP once your income exceeds about $164,000 last year. That will give you the $29,000 of room availability this year. Now, you're the one who has to decide if you're going to make use of that room, and hopefully you will, and you've got accumulation, but the availability of it is based on that calculation. So there's a maximum amount you can put into an RSP, and then you can keep an RSP as long as you want up until the year that you turn 71. By the end of that year, and you can do this sooner, but by the end of the year, you have to do one of three things or a combination of them. Cash things out entirely, use some of that money to buy a registered annuity. So from an insurance company, you take a lump of money, and then the insurance company will then pay you over the course of your remaining life the payments that were going to be made to you annually. Usually it's done on a monthly basis, but that is an annuity payment that's made to you. Or you take that amount of money and you move from an RSP into a registered retirement income, a RIF. So you can do any of those three things. I'm just going to talk about now how the RIF operates. So in comparison to an RSP, which is an accumulating vehicle where you have a maximum amount that can go into the RSP, a RIF is a decumulating vehicle. It's still invested. It still gets tax sheltering like your RSP did on the way up. So you still make investment decisions. You're able to grow tax sheltered within the plan, but there is a minimum amount that must come out of your RIF every year from the time that you turn it into a RIF from being an RSP. So maximum you can put into an RSP, minimum that must come out of a RIF. So there's some symmetry involved in how these two things operate. When money is paid out of a RIF, it is taxable as it's taken out of that RIF, and there will be withholding tax when those payments are made to you, but there is no withholding tax on the minimum that is taken out. So the minimum, prescribed minimum on the tax regulations that must come out, there's no withholding tax associated with that. But if you're taking an amount over and above that, then there will be some withholding tax that would attach to that. And withholding tax is an estimate based on the tax rules, an estimate of how much tax you ultimately will be required to make a payment on for tax out of the withdrawals. And then when you file your taxes, when you do your tax return in the following April, you then get credit for the amount that was withheld. And if there's any more due, then you'll have to pay in. And if it was too much, then you'll get some back. And I know a lot of people don't like the idea of there being that withholding. They'd rather have the money themselves, but it does keep things on track. And sometimes these things can get out of control if you're not careful about it. And from the government's perspective, they don't want to be in a position where you may have spent all that money and you owe tax and you don't have a source for it, which is not going to be good for overall government revenues, but it's not going to be good for any of us individually if those things happen, because it puts us in a serious bind. If you have a significant amount of income over and above what the withholding tax might have been, and that can happen with some people who are in their retirement years, then you may be required to make quarterly tax installments to, again, pay in what is the estimate of what you would be required to pay in your taxes. You may be required to do that. It usually takes a couple of years of tax payments before the tax records, based on your filings, indicate that you are under underpaying your taxes during the course of the year, and then the government may cause you to be then a quarterly tax installment payer. Again, understanding that you will get recognition of that when you file your taxes coming around to the tax filing time. So this is not an extra tax. Withholding tax is not extra tax. A quarterly installment is not extra tax. It is a prepayment, or it's a payment of your taxes during the course of the year that you do get the recognition for. Now, when you get into your retirement years, you are now at a point where you can start drawing off. And one of the things that you can do to reduce down the tax bill in the household, if you've got a spouse, is to make use of the pension income splitting rules. And the way that these operate is where you have an income source yourself, you as the person who is the pensioner or the annuitant on the registered plan, you get payments that come from the plan. And you are able, based on these rules, to split up to 50% of eligible pension income over to your spouse when you come around to tax filing time. So again, the limit is 50%, and it's at tax filing time, not during the course of the year. So you, the person who has that plan, will get those payments over the course of the year. And then when you come to tax filing time, it's up to you whether you want to split and how much up to that maximum of 50%. Now, if you're under the age of 65, registered pension plan money does qualify for the eligible pension income, and therefore for the splitting. RSPs do not qualify at any time if you just pull money directly out of an RSP. But RIF money may qualify under the age of 65 in relatively unusual circumstances where the payments are being made to you because you have a spouse who has predeceased you. So now you have a new spouse, and you would be able to use some of those amounts to then split over with your new spouse. More commonly, though, you'll have somebody taking withdrawals from a RIF only being able to use the pension income splitting rules once you hit, as the pensioner, once you hit age 65. So once you hit 65, then you are able to split up to 50% of RIF payments coming out into your hands. When that amount is split over to your spouse, then it's taxed over to your spouse, and the withdrawals from the registered plans qualify for the pension credit for you as the pensioner, and also on the split amounts, they will also qualify for the pension credit on those amounts going over to your spouse. So you are able to both reduce taxes, presumably if you had one person in the extreme who is getting all the income, then we have a progressive tax rate system where at higher levels you pay higher rates of tax. Well, if you can take half of this, put it over into someone else's hands, then both of you stay a bit lower, you pay less taxes, and you have the pension credits available on the first $2,000 of income that reduces down somewhat in lower income levels, eliminates the tax that would otherwise apply on that first $2,000 of income. The $2,000 amount is the federal tax credit. There's also a provincial credit that applies on a similar level of income. And then we have these other places where you might have savings that aren't formally retirement savings plans, but certainly are places where you can save, and you would be looking at drawing those down in your later years, making use of them. I mean, drawing down sounds like you're just knocking things out, but using your savings for your own benefit. So you may very well have used a tax-free savings account where you've put after-tax money into the plan. You've got the tax sheltering when you grow that money, and then when you take it out, non-taxable, which is a nice benefit of the tax-free savings account. You didn't get the tax break going into it, but you get the tax sheltering and you get non-taxation coming out, which is going to be a coordinating type of plan to work with your other retirement savings. You may very well have non-registered investments. If you've maxed out on the availability of these tax sheltered plans, then your next investment dollars might go over towards non-registered investments. Or it could be that maybe you received an inheritance or some kind of a windfall that the decision was made not to make use of all of those tax sheltering plans and have that in a non-registered investment plan. And when you then take the money out of those plans, you'll have income which is generated from that during the course of owning those investments, interest and dividends that are paid to you. And when you pay off or you pull money out of those investments, then the growth in value will be taxed to you as a capital gain. So that's one of the things that you can use to draw down on. The nice thing about the capital gains is that you're not taxed on capital gains while it's growing. And as you take money out of those non-registered investments, the entire capital gain is not taxed to you as the money is taken out. It's a proportion of the amount that you're taking out compared to the amount which you've accumulated in the first place. You may have a business, in which case you'll be looking at winding up a business. It's just well beyond our conversation here, but that is also a place where you would have source of income. And you may also have life insurance that you've put in place for protective purposes. If you die at an early stage and you can't provide for your family anymore, then the life insurance is a pool of money that comes in and stands in place of you as a dollar amount to be drawn from. And as well, life insurance has some income tax sheltering capability that it can grow up in value so that it can then be paid out on a tax free basis to the beneficiaries that you have. That may be something that is, again, coordinated between you as spouses so that one is providing for the other through a life insurance policy, or in both ways, or to provide for your broader family, whether that's dependent children who will then be supported by the insurance proceeds, or to fund up the estate that you have. A life insurance might be something that can work for you in that way. So then you then have your non-financial, and I did talk a bit about the other investments that you have beyond the retirement savings, but then we come over to housing. And so with housing, then sometimes people will look at their house as being a source of retirement income because you want to downsize. You're going to accumulate in value over the course of your working life and your life as it is. And then you may be looking at that as a source of retirement income, whether it's going to be a significant part or a supplement or not, does depend on the value that's involved. What I want to emphasize here is being careful about this, because you're always going to need somewhere to live. So the idea that you're just going to be able to pull the money out of the place where you live is not always going to be capable for you to be doing that. So you've got your house. If you decided that you're going to own rather than rent, you can grow up in value, and then when you sell the property, if it's your principal residence, then the capital gain is not taxable. Now, normally, capital gains on investment properties or on second properties that you choose not to use the principal residence exemption upon, normally the capital gains with those do grow up without being taxed while the growth is happening. But then when you sell, half of the capital gain is taxable. It's brought into your income in the year that you sell. With a principal residence, you are able to use the principal residence exemption so that none of the capital gain is taxable when you take the money out, when you sell off the home that is your principal residence. So when you look at that, it might seem like this is a great place to put some of your wealth, and certainly as a way to fund your current and your future shelter needs. Owning and renting is a debate that people are always having, but it is certainly something that is very common in our culture, to own a property and to live in it and to grow up value. But then when it comes around to downsizing, you have to think carefully about where are you going. Are you going from that place into a place that is significantly different in terms of the cost of the housing? Or maybe are you going from your 5-bedroom house that you've been living in to a 3-bedroom house 3 blocks away, or 3 miles, or 30 miles away? Are you actually going to a place which is significantly different in terms of the real estate market? And you're going to a place that is significantly smaller than where you are right now, because there are costs involved in moving from one place to another. And as you move, you might think that you are going to harvest out a fair amount of money, and you likely will if you're going to be downsizing, but you have the costs that are involved, the transactional costs that are involved in moving from a property. You're going to have real estate commissions. You may have land transfer taxes that are involved. Certainly in Ontario, we have land transfer taxes. All of the appliances that you might have to buy on the other end of things, reaccommodating in those places, that is going to eat up some of that money. So be careful about assuming that you're going to harvest out a large gross amount of money from the downsize. The net after all of these things have happened may not be quite as large as you expect it to be. And if you're going to do this on a number of occasions, then you're going to have those transactional costs happen more than one time, which again can eat away at your capital. And when you do that, then what are you going to do with that excess money? Even if you sold the whole thing off and went to rental accommodation, you need to then provide for yourself in your housing needs to pay that rent. You can't just spend all of that. You have to make sure that it's still available. You no longer own a house, perhaps, or an apartment, but you now have to pay regular rent that you didn't have to pay when you were an owner. So you need to make sure that you've got enough that will take care of paying those amounts. So when you're harvesting out that value, when do you want to do that? What are the stages that might be involved as you're moving from one place to another? And have you allowed then for the transactional costs that will eat away at that as you move from one place to another, as I say? So there's some of your assets that you have, the financial assets, as well as the hard assets, the hard asset being the house mainly. And so now I want to come to this question that gets posed about how do you draw down off of the various sources of income? So I'm coming back to the financial assets. People will often say, well, do I start by drawing off of all of my tax-free savings account, and then I have my RSP money that then I RIF and start taking that out? Or do I do the RIF money first and I leave the TFSA to grow? And if I've got non-registered money, do I do that? If I own my house, do I own it and not sell it until the very last moment? How do I go about doing those things? And the answer that I have to that is there's no simple answer to it. I mean, there really isn't a simple answer to it. What we need to keep an eye on when we're going into our retirement years is that we do have as I mentioned, a progressive tax system where as we go to higher income levels, we pay a higher tax at each of those income levels. And so the nature of the income sources that we're drawing from have to be taken into consideration as we are drawing from them. Money that comes out of a RIF is fully taxable. So, and when I say that, I don't mean it's taxed at the top bracket. I mean that it's added to your income in that year. Money that comes from a non-registered investment, you get back your own capital non-taxed, but then the capital gain that you realize on that, half of it is taxable, again, added to your income. Tax-free savings account, there is no tax on the withdrawals that are made from that. Some combination of those then in a given year is going to be drawn out so that in ideal circumstance, you're going to keep from going up into higher brackets each year, and you'll be looking at your current income level and looking at across time. So I use this chess analogy to do the comparison with you or me going into retirement and how chess operates. And apologies to those of you who don't play chess. There's two players that are involved in this, and each of them have 16 pieces they can play. And so that's 32 pieces in total on a 64 square board. So half of the spaces are already taken before the play starts. And then as the play starts, the first player is the white player. There are 20 possible moves that person can make. And then the second player is the black, and there are 20 possible moves. By the time you get to the second move of the white player, there are 400 possible permutations of the board that could happen. And by the time each of them take another move, you're up to almost 200,000, and then one more move each, and you're over 119 million possible permutations to what the board looks like. That's talking about this fixed space of a chessboard, and there's that many possibilities of what it might look like out there in the future. That's a lot different than what happens with your retirement, where the kinds of things that happen don't fall into little squares. They could be anything, and they could be a lot more degrees of difference rather than discretely moving from one square to the next. So as you're looking at the decumulation of the sources that you have, tax, as I mentioned, with the different sources, tax has to be a large part of the consideration when you're drawing down from those sources. In order to make sure that you have a pleasant, happy retirement, you want to look at your lifestyle that you have, and then have that lifestyle while minimizing taxes. Don't look at it as I must pay as little tax as possible. I don't mean to lecture to anybody, but to have tax as your lead consideration, it leaves out the main thing that you've been doing over the course of your life, which is to save during your younger years so that you accumulate to take care of yourself in your older years. And if you're just doing the drawdown based on minimizing taxes, then it's not going to make things a very happy retirement if you're constantly focused on the spreadsheets for doing that. So when you do that, then you ideally, again, will be looking at minimizing your taxes over the course of all the years of your retirement. You don't know how long you're going to live, but as you come to look at it each year, as you're looking forward, you'll look at trying to keep the taxes down this year, and then the sources that you have available to you looking forward in time with the benefit of your financial advisor, how it is that you project out how you're going to draw down parts of those over the course of time to try to keep below going into higher tax brackets. So you're going to look forward in time, you're going to do an annual review based on your personal circumstances that you have at that time, what wealth you have available to you, and what changes might be happening during the course of the last year since you had your last review. Then you'll make a decision about how you're going to draw down your money. Now, I'm making it sound really, really complicated, but really you go through this process as you're leading up to your retirement of what you expect is going to happen, and then you just make adjustments from year to year once you set out your baseline of what's going to happen. It's not a matter of saying, I take all of this and then all of that and all of the other. It's looking at those and saying, what is the best formula? What's the best recipe? How I'm going to do this year in order to make sure that I'm taking care of myself next year and the years after. And I'll come back to that as I go into those later years. I'll give you a couple of just visuals to look at as things that might help out with the thought process, not the numbers, but what this is here. I listed off here those different places that I've identified as your sources of wealth. We've got your work savings, we've got your public pensions, we've got your private source savings, and then we've got real estate. As you look out into your retirement years, and you can retire as early as you want, but I'm just showing the range roughly between 60 and 71. And why am I doing that? Because that tends to be what we think about as our retirement years. It does take a while to accumulate enough to take care of ourselves. And so there are people who might be able to retire earlier than that, but this tends to be the range of time that the decisions are made. This is also the time when you take your Canada pension plan and your old age security in this age 60 to 70 time frame. RSPs, you have to collapse them into either cash or the registered annuity or a RIF by 71. The rest of those things, there are no limits on when you have to cash them out, but you can take this kind of grid and just put X's next to them and say, well, where do I expect my sources of income to be coming from based on what I already have? And then the arithmetic of what the numbers actually are, again, that's a conversation to have based on your numbers, your sources, with your financial advisor to determine what's appropriate for you. But this will at least give you a visual of which things you'll draw down, when those things are going to start. So you've got an idea of the sources of those things. And then the last thing that I'll leave you with is to look at your retirement in terms of how do you expect you're going to be spending time in your retirement? And yes, we definitely need to fund it. We need to have the dollars that are involved in it. But in order to look forward at what we might be doing in our retirement, this it's sort of an acronym of sorts, DOEMA, Sean, it works into, or I've used this as the reference to things that you do on a daily, weekly, monthly, seasonal, or annual basis. And based on what you're doing right now, what does it look like you're going to be doing in your retirement years? So based on what you're doing right now, how do you spend your time today? And how you spend your time, how much money do you spend on those things, whether that's on a daily or weekly, etc. basis. Typically you might, and I'll just use the first one here, typically you might have a small coffee and then occasionally you'd have a large coffee. And that's going to be something that shows you what your budgeting has been during the course of your working years. And you can apply that to each of these things that you do mainly or regularly on a daily, weekly, monthly, etc. basis. And that'll give you an indication of what you can look at in terms of what you'll do in your retirement years. So you're not necessarily going to do exactly the same things, but some of those things won't change much, if at all. Others will be significantly different. So if these are the things that you tend to do in your working years, some of them will be mandatory upon you. Others will be things that you would like to do more of. Others will be things that you'd like to do less of. So looking at this, again, mapping out the sources that I was just looking at, the sources of where you're going to fund your retirement is going to give you an idea of how you draw off of those things that you've accumulated. And then this gives you a little bit more of a picture of what you're going to be doing in your retirement years. And though I've only got a few boxes showing here, you can do this on a piece of paper and just write down, what are the things that I usually do every day? Am I going to do that? Do I want to do that in my retirement? Or do I want to do more of this or another thing? If I do these certain things once a month right now, but I'd really like to do a lot more of it, then you look at your retirement and say, those are things I want to do. That then is going to tell you what you would like to do. And then you marry that up with the cost of doing those things. And that'll give you an idea if you're staying within your range of your retirement accumulation, your money that you have available to you. And then that comes back to how you're going to draw down off that money when you go into your retirement. So there's the picture of things. Sean, I'll bring you back in again and see if we have any questions that came up while I've been yapping on here.
Thank you, Doug. No, that was great, and certainly you went through a ton of information in a short period of time, and I know that we've got some questions there. Certainly, I've taken some notes as well, and we'll try and get through everything as much as we can. I know there's been a lot of interest, a lot of individuals also asking some questions that are related to them personally, and we've provided some guidance on that throughout some of the chat. One of the things you mentioned, Doug, was clawback of government benefits. And so a great question that came in is, what is that number, and does that change from year to year in terms of the income that is taxable that would result in a clawback? So perhaps you know that, or you could share that with us.
Actually, I'm going to switch my screens because it's in the high 70s, and I'll go grab the exact number so I can tell you exactly what it is here right now. So old age security. The old age security clawback level right now, maybe you know this, Sean.
I know it's around 70,000 roughly, give or take a few thousand.
Yeah, it's around 70,000. Yeah, I can't find it on the screen that I just brought up here, but yeah, it's around 70,000. Why can't I find it? I got.
And that's fine. Now we can certainly provide that info. I mean, it's a good guideline, and it's certainly available on the CRA website, I'm sure.
Yeah.
But I think a couple of questions that came through as sort of a thematic, I would say, is this whole notion of when to trigger government benefits. Do you do it early? Do you do it later? And I know you had a couple of slides on the benefits of the income you would receive by delaying it on a month-to-month basis or taking it early on a month-to-month basis. And there's obviously a number of variables that go into that, such as your planned life expectancy, other sources of income, and so forth. But generally speaking, and I know there's no magic formula, theoretically, it would make sense to try and defer that. And correct me if my logic is wrong, but I'm thinking of personal situations as well with my own family. Theoretically, it would make sense to defer receiving government benefits further out because we know that the average life expectancy continues to go up for both males and females. And at the same time, try and leverage your taxable income earlier on in retirement and draw that down and then trigger the government benefits later on. And hopefully you'll minimize any clawback around OAS as well. With that as a broad you
Yeah,
know,
and,
and
and
you,
that's my, I mean, easy for me to say perhaps because I'm not drawing on those things right now, and I'm not that close to it, although I'm closer to 60 than 50. Um, but the general idea is to try not to let your emotions drive your decision making. Look at the logic of how it is that these programs operate, and practically what your life expectancy is. And there will be exceptions because you personally maybe have a lower life expectancy, but generally we as people tend to underestimate our life expectancies, and we may shoot ourselves in the foot by doing that if we live out to just life expectancy as it is. And if we happen to be part of the cohort that goes beyond it, then it's that much more painful to us in those later years if we have taken our savings and instead use the government money earlier at a lower amount than what would have been available to us had we deferred. So it's not a definitive, but I lean towards, personally, I lean towards starting on the default that you're going to delay it until as late as you can, and then finding reasons that you might take it earlier rather than the other way around, that taking it and finding reasons that would extend you out.
thank you, Doug. And we've got a lot of active chat in the chat room for people contributing and saying that the maximum amount before clawback, I believe, is 79,054. So we'll verify that, but certainly great to see that activity in the chat room. One of the questions that came in, Doug, was, what about retiring abroad? Does that have any impact on strategies or taxes as it relates to drawing down income if you're a non-resident?
Yeah, if you are simply spending time about like a snowbird, then that's not really going to change a lot. I mean, certainly you've got costs that are associated with that, either less or more. But being in another place does not make you necessarily a non-resident of Canada. But actually becoming a non-resident, so breaking your ties with Canada so that you are no longer a Canadian resident for tax purposes, will also mean that the payments that are made to you are made to you based on you being a non-resident. And so the withholding taxes on that are different. The general rule is there's 25% withholding tax on payments to non-residents. So if you're drawing down on your RSP RIF money, then that is going to be subject to that 25% withholding. If you're in that position where you intend to become a tax non-resident, then you definitely want to make sure that you talk to your tax advisor, your tax professional you work with, to make sure that you actually do break ties in the way that you intend, or that you don't if you don't intend, because there is a deemed disposition of your property at the point that you become a non-resident, and that might not be what you intend to have happen. So yeah, there are additional considerations where you're going to become a non-resident that is going to make things more complicated, but more complicated in a positive way if you plan things out in that way.
Yeah. We've got a few minutes, and I do want to get through a couple of these questions because they are coming in. Doug, could you please just clarify on the withholding tax as it relates to RIF payments, and whether the withholding tax is applied even if the minimum was withdrawn?
The withholding tax applies on the amount above the minimum.
Great, thank you. And also on the OAS clawback, similar question. The clawback, can you explain a little more of how the clawback, what that means? So I think there's confusion around, are they clawing back my income, or is it just the benefit?
Yeah. Okay. Well, it's really complicated, actually, and I mean that it really is complicated. So what happens is, if your income exceeds the level and we'll call it $80,000 for round numbers here, if it exceeds that level, then your next round of old age security payments, you'll receive a little bit less in those next round of OAS OAS payments. The OAS payment year runs from July to June, so July the 1st to June 30th. Once the government has your tax numbers when you file in April, then that allows them to make the calculation of what your payments are going to be the following July 1st onwards. So you don't end up losing out as in paying more taxes on your tax return. You get clawed back or reduced on the amount of old age security payments you have on the next round of payments from July the 1st. That's not the best explanation, but that's why I say it's quite complicated.
No, and it certainly goes into, how we decide on possibly even when we're taking income, correct? Because that would have an impact.
Yeah, and if you something like selling off your cottage, you're probably going to end up losing your old age security in that year because of the capital gain associated with it. It'll push your income up really high in that 1 year. But if your alternative would be to sell off parts of it or transfer some ownership 1 year and then another year and another year, if you're able to do that, then you might actually lose your old age security multiple years rather than taking the one hit in the single year. So those are the kinds of things that you do have to look at and say, am I okay with losing the old age security at one time totally, rather than losing more of it over the course of a number of years? It's a tough, it has to be reviewed with the income sources you have.
Great. Folks, we are at 4 o'clock, and I do see the questions are continue to come in. I will take one more question here, which I thought was interesting, and that is in regards to an individual perhaps who has very few savings or group pension, private pension plans, but has a lot of equity in their homes. And the question is, can we think about using a reverse mortgage as a way to fund our retirement? And absolutely, there are options to consider around reverse mortgages. They are gaining in popularity in Canada. I would certainly say that it is something to really have a good look at and be advised on if that is a course of action you want to take, because there are downstream impacts across, to beneficiaries or anyone else who you might be considering providing some of the assets to down the road. But certainly, we have received many questions. I would encourage, for those of you who have submitted questions that we could not get an answer to, please send an email to wealth@alterna.ca, and we will answer all the questions and provide you timely guidance on any specific situations you may have personally. A copy of this webinar will be available on our website in about a couple of days, and we'd be more than happy to assist you with any of those discussions. You can visit a branch. You can visit us at alterna.ca under the Wealth Management tab. That's where we'll house the webinar recording. And we also ask that you please complete the survey that we will send out. We want to make sure that we provide webinars that are timely, that are of value to you. And certainly, your feedback is important so that we can, deliver the best content that is important. With that, we will end the webinar. Our next webinar is on March 23rd, and we will provide some details in an upcoming invite. I want to thank Doug, and I want to thank all of you who participated and submitted a great number of questions, and we'll certainly see you at the next webinar. Thank you so much.
Thanks, John.
Thank you.